Good afternoon, everyone, and welcome to our Realise Business Expert webinar. Thanks for joining us today. My name is Jacqueline, and I am the Marketing Manager for Realise Business. For those of you that aren't familiar with this, Realise Business is a leading social enterprise empowering people to successfully run a business. Through our webinars, we bring our advisors and members together to share their expert knowledge in the interest of helping each other to learn and grow to their highest potential. So these are webinars that we put together for you. That is a perk to being one of our Premium or Premium Plus members. And today, one of our Premium Plus members, Amy Chen, is here to present the webinar, Preparing for Your Small Business Loan. And this is really something that Amy specializes in and has been doing for many, many years. So we're very lucky to have her sharing this with us today. So before I throw to Amy, I'm just going to run through some quick housekeeping points. If you have any questions during the presentation, type them into the question box. You can bring it up on the right-hand side of the screen by pushing on the chat icon at the bottom of the screen or by pressing Alt-H. I'll bring the questions up during the presentation at my discretion, or otherwise we'll have plenty of time for questions at the end. So without any further ado, I'd like to formally introduce our presenter to you for today, Amy Chen. So welcome, Amy.
Thank you, Jacqueline. And it's really lovely to speak with all of you today. So as Jacqueline mentioned, my main background has been in financial services, mainly as a lender. And a big part of what I used to do was working out whether a bank should lend to a particular business. So I used to analyse a particular business, look at their financials and look at their position to see whether the bank wanted to lend to them or not. So I've got a pretty good idea in terms of what lenders are looking for, why they do what they do. And during my time, I always knew that small business owners found the borrowing process difficult. But I never really had a full appreciation of how hard things were until I started working with small businesses as a consultant and also being a small business myself. So what I want to share with you today is what lenders are looking for when they're assessing your loan application, why they ask for what seems like stupid and unnecessary pieces of information, and then how to make yourself more bankable so the process is easier, less stressful, and how to make sure that you sign up for the right thing for your business. Okay, so as with anything financial, I just want to get this out of the way. I just need to mention that what we're discussing today is general in nature, and that before you make any changes that could affect your personal financial position, that you should seek the right advice for your personal circumstances. The other thing I should mention is that we're talking about loans for your business rather than a loan for you personally. So my background has always been in the commercial space, and retail banking is really a whole different kettle of fish with its own regulations. Just so you're aware, like, you know, this is mostly to do with commercial lending. Okay, so for anyone who's gone through the lending process, are you alone in thinking getting a small business loan is hard? Well, the answer is no. So Xero did a survey called the State of Lending. And what they found in their survey of small businesses was that at least 76% of small businesses believed getting a loan was difficult. And at least 51% believed it's at least the same or more stressful than buying a property. 80% believed the documentation and the other requirements needed to get a business loan were too onerous. 42% of you said the hardest part about getting a loan was getting the financials together. And 22% believed that funding was your biggest pain point and the one thing that was holding up growth. And it's not like small business doesn't want to borrow. The same Xero report found that small businesses in Australia would collectively borrow at least $80 billion over the next 12 months if they could get the funding. The reality is that small businesses struggle to get the finance they need because the process of getting a loan is complicated and it's hard. And I don't know whether anyone agrees with me, but certainly the businesses I talk to sort of share that view. So why is getting a loan so hard? So where I thought I'd start is to give you a picture of what lenders are looking for, because if you have a better understanding of where you as a small business sits in the scheme of things, and you can change your approach to the loans process just to make it the next time a more sort of successful and a less stressful time. Now, when it comes to small business loans, the reality is to a bank or to a lender, they're generally low profit and they're low dollar value, especially when you compare these two loans to, say, large corporates, which can run into the hundreds of millions of dollars. And there's lots of little loans to look at for them to make enough money to justify it. So to make the lending process easier for them, when it comes to assessing your loans, they basically run through a checklist of things to tick off to see whether you qualify. And it seems harsh, but really that's the reality. If you don't fit their criteria, it can be very difficult to fund finance. So what are lenders looking for? So the one thing that we look at when certainly when I worked on the lending side, the one thing we look at when we decide whether we want to lend a business money is a couple of things. So we look at the financial health of your business and whether you can repay your loan. We look at what you'd be like as a borrower, so what kind of behaviours you show. And then the final thing we look at is how would we get our money back if you can't repay? So it's partly how you prepare your business to become loan ready, as well as the quality of information you give them that will determine how successful or how stressful your loan application will be. So what can you do to make yourself more bankable? So we'll run through a couple of things in a little bit more detail. So we'll look at creating and maintaining a strong credit profile, having a cash management strategy, having a plan for your business and for your loan, being across your numbers and keeping them in order, and also paying your taxes. Now, part one, your credit profile. Now, almost all lenders will run a credit check on you because what it does is it gives you an insight on the way that you run your business and also what you'd be like as a borrower. So it's almost a behavioural check. And the key thing they're looking for is whether you've got a history of late payments or have defaulted on loans before. So you can actually start prepping for a business loan way before you even approach a lender or a broker. And that's by checking what your credit profile looks like and taking the action you need to make yourself more lendable, which will increase your chances of getting a loan, and usually at a lower interest rate. Now, you can get a free copy of your credit report from the major credit reporting agencies that the lenders use. And the main three that they use are Equifax, Illion, and Experian. So we can give you those details in a separate email. Now, when you get your report, and it is free to get, what you need to do is check for any errors, because there's been lots of cases in the past where the wrong listing has been placed on your report and it's actually prevented people from getting a loan. There's also been cases of mistaken identity that have been picked up from credit reports, as well as identity theft as well. So there's a few things that, it is actually quite useful to check these reports. The reason these happened is that these agencies deal with thousands of pieces of information. So again, mistakes are extremely common. There is a very set process in which you can get these corrected, and lenders as well as the credit agencies are obligated to correct these mistakes for you. We've actually got a more detailed webinar just looking at credit scoring in April. So we'll look at ways on improving your credit score. But in essence, what you want to do is just make sure there's no mistakes on your report, pay your bills on time, make your loan repayments on time, just so you don't get a default listed on your profile. So that's your credit profile. Part two is managing your cash. So cash is very much like gas. It can disappear as soon as it arrives. So it's important for your business that you start putting away a little bit of money each month or each week for a rainy day, because if something goes wrong, it can go wrong very quickly and it can hit you in the face really quickly. Now, this might mean that you just allocate a bit of cash that you receive from your clients into separate bank accounts. So you can separate things into things like business expenses, putting aside money for tax, future growth, for your rainy day fund. basically do whatever you need to do to organize your cash and remove the temptation. Because often when we see cash in our account, we think, great, we can buy something. And if you have the money stashed away, not only will it take the urgency out of finding finance when you desperately need it, it also demonstrates to your lender your business's capacity to save and manage cash. The stronger your business position, the kinder your lender is going to be to your loan application, because they'll see you as a less risky proposition. Now, having a plan. Now, I worked in lending for a very long time. It's well over 12 years. And I found that a lot of small business owners waited until too late to find debt. And what happens is that panic will often set in. Owners will get really stressed about having enough money to meet their repayments, and they end up taking the first thing that comes along, and it's usually a loan that's really expensive or has really onerous conditions, basically because I don't have any options left. And there was just no time left to negotiate a better deal. So if you wait until you really, really need cash, you might be forced to take a less than ideal option, like something with a really high interest rate. So how do you know you're going to need a loan? The cash flow forecasting is something you should be using to manage your business anyway. So, and it's not the P&L that your accountant produces for you. It often is done on a spreadsheet quite separate. And it's all about the timing of when cash comes into your business and when you need to pay it out. So using a cash flow forecast, you'll be able to project out what your likely sales are and when you're going to receive cash from your clients, and then plan your expenses like wages and your creditors and tax, and precisely when you need to pay the money away. So think of it as a tool that allows you to know exactly how much you need to have in your bank account to be able to meet your bills, interest, loan repayments and tax payments on time. By staying on top of your cash and doing ongoing forecasts, you'll know when there's going to be a potential cash shortage, and it'll give you enough time to plan ahead and seek a loan that suits your needs. You'll actually have a better chance of approval if you seek finance early. It's actually ironic. It'll be easier for you to get a loan when you don't actually need it. So basically because the lender will see you as less risky and more likely to be able to pay them back. Now, our next webinar in March is actually all about making cash forecasting easy. So it's not, most people have this vision of this 42 tab financial model, but basically you can do a cash forecast in a really basic spreadsheet, and we'll run through it next month. So the other thing the next thing is knowing your numbers and be clear on what you're using the funds for. So when you apply for a loan, what's it for? Is it for growth? Is it for a piece of equipment? Is it to cover a seasonal shortage of cash? Most lenders will hesitate, obviously, if you're going to use the business loan to fund effectively what is a lifestyle expense, like a new Mercedes. So knowing the purpose of your loan means that you can find a loan option that actually suits your requirements and your cash flow. So leases for a piece of equipment is usually better because the payments are spread out through the life of that piece of equipment. Overdrafts can be better for a seasonal fluctuation. A bullet loan or a traditional bank loan might be better if you were, say, building a new facility. And this is where a cash flow forecast can actually come in useful. You can demonstrate to your lender what the net benefit to your business will be, and you'll be able to plan to have enough cash to make your payments on time. Now, knowing your numbers and keeping your accounts in order. Now, a Xero survey found that 42% of small business owners found getting their financial reports ready to send to lenders one of their biggest hurdles. And I've seen firsthand, having worked with small businesses through this process. Now, a lender will typically ask for 3 years of financial statements so they can see what your past trading performance was like. And they'll use that information to work out how well you manage your business and whether they can lend to you without losing their money. working with people like your accountant and bookkeeper to stay on top of your numbers is crucial, just to make sure that everything's in order. So when you do need a loan, these things are ready, these reports are ready to go. And the other thing that's important is to understand what your numbers are telling you. One of the best things you can do is to get finance ready, is to know your numbers and keeping your books in order, which will increase your chances of getting a loan. If you're a newer business, the first couple of years will likely show a loss, and sometimes you can supplement this information to support a stronger trading position. So things like a cash forecast can help. A summary of your upcoming and current projects to show how much these are worth and what likelihood you are to win new contracts that are coming up. If you're borrowing to support the expenses of a new contract you've just won, if you're allowed to, a copy of this contract can help. And sometimes a list of who your customers are and how much work you do for them, because if you're dealing with a cashed up counterparty, your potential lender might be more reassured that you're going to be paid for the work that you've done. As I said, know your numbers so you can answer any questions from your lender with confidence, like how much it costs to provide your goods and services, or why expenses blew out in a certain year, and so on. Demonstrating that you're an engaged and organised owner can only add to your chances of having your loan approved. Now, taxes. Now, it doesn't, one of the biggest things that we had to do when I worked for the bank was, or actually not just the bank, when I was doing government funding as well, was that we had to confirm the tax status of any prospective new borrower. And what it does, it shows behavioural patterns. It shows whether you're on top of your business. And the other thing it does, it identifies potential liabilities that might not appear on your financial statements or your balance sheet. The other thing I've seen firsthand is that the ATO can and does issue wind-up orders against small businesses that have unpaid tax. And while you can continue to trade while this wind-up wind-up status is in place, it does put a real strain on your cash flow. So basically, suppliers would put most of the small businesses I dealt with, their suppliers would put them on stop supply and demanded cash on delivery for all of their purchases, which was hell on cash flow. So basically, these customers would come running to us for an excess on their overdraft because they just couldn't pay their suppliers up front because they hadn't received the cash from their customers. So it is valuable to check. Now, if you leave your taxes to your bookkeeper or your tax agent, you can ask for access to your ATO portal, which will give you which will allow you to see your company tax, your GST, and your payroll status yourself. Now, if you're looking for a loan, it's not just typical bank loans that are available to you. Okay, so traditional bank loans are just one option, and other types of finance might suit you better depending on why you need to borrow. Now, so it's worth doing some research into options like equipment finance, invoice financing, vendor, floor plan, and op and finance leases, because these could all be alternatives that could present you with a less restrictive option for your business. Now, I'll run through a few examples just so you can see the kind of differences between why you need the funding and, you know, why an option might be better for you versus another. So the first one is business credit cards. Now, these are very popular because they're easy to use, and you can earn reward points that you can use later on. They can also help keep your business and personal expenses separate and allow you to track your repayments through online banking. But they are typically high interest rate, and they're usually best suited for short-term finances. Short-term financing for smaller amounts that you need very quickly. One thing to check is what the annual fees like, because sometimes they can be very high. And you also need to manage your cash flow in a way that allows you to clear these amounts every month, because as I mentioned, it's an expensive form of finance and it's really only suited for small amounts for very short periods. Now, overdrafts give you ongoing access to funds, which can be handy if you have short-term cash shortages or expenses you didn't expect or seasonal fluctuations. So sometimes timing doesn't work in our favor, and there's a bit of a lag time between when we have to pay a bill and when our customer pays us. So it's a relatively expensive form of finance. So do be diligent if you need to dip into it. Easy-ish to set up, but it is an on-demand facility. So the risk that you run is that your lender can potentially change your limit or cut it off at any time. So it's just another risk to consider if you rely on it too much. So now, secured and unsecured loans. No, secured loans are more your traditional loans that you would apply for. And if you needed a large lump sum to purchase a piece of equipment or property, typically they would have a lower interest rate than an overdraft and a credit card, but they do take a little bit more work to set up upfront. Secured loans are usually the cheaper of the two and do require you to offer up collateral of some sort. So you need to offer up an asset in exchange for the loan. Your lender, so it's just in case you default on the loan and can't pay, your lender can claim that asset and sell it if you can't meet the terms of the loan. Unsecured loans don't require as much security and can be quicker to get, but usually more expensive, so more suited to shorter term and for lower amounts. Now, more specialist facilities include invoice discounting and factoring. Now, these involve selling or borrowing against your outstanding invoices to your lender at a discount, so you can get the cash straight away, so you don't have to wait for your customers to pay. The two, invoice discounting and factoring, are slightly different, and I won't run into the differences here. But what I will say is that lenders are typically very picky about which customer invoices they'll accept. And there's also a lot of admin, ongoing admin involved. So you do have to have relatively efficient systems already set up. Compared to a secured loan, it is more, it can be a more expensive form of finance, because the cash that you end up getting at the end will be less than what you get than compared to when you collect a client invoice in full. But on the other hand, it may work well for your business depending on kind of asset mix you've got. The other factor to consider is that they can be cumbersome to administer and take a long time to set up. And then operating and finance leases. Most people know about these, so I won't run into them in too much detail. Normally handy if you want to fund a specific asset, and the payments are often spread through the life of that asset and will line up with the cash flow that that asset would generate. So you can sort of line up the repayment profile that way. Often there's a bullet repayment at the end if you want to keep the asset. So, and the security is often limited to the asset themselves. So it sort of, if you default on that, it's only the asset that gets affected, unless there's a guarantee of some sort that's been placed on the facility. So those are the different types of loans. Those aren't the only loans, but it just gives you an insight into there's different options available. So it's always worth looking at different options versus just a normal bank loan or a normal lender loan. So now what I'm going to run through now is that when you do come to a point where you're ready to get a loan, be very aware of what you're signing up for. For those of you who have gone through the loans process, you'll know that the contracts aren't straightforward. They're very long, they can be complicated, and they're written in legal jargon. So you're going to need a lawyer to run through them with you, just so you understand what you're signing up for. Now, there's been a lot of small business groups that have been pushing for simpler lending contracts from banks and other lenders, but really, the reality is, and based on my own experience negotiating these contracts, I don't think this is going to happen anytime soon. And I know it sounds really obvious. So whatever option you end up choosing, just make sure you get the right advice. Make sure you understand what assets, whether they're personal or business, that you've pledged in exchange for the loan. and then you're comfortable with the loan that you've chosen and it suits your circumstances. Do your homework. Make sure you're not overextending your business finances, which is where your cash flow forecast is going to come in handy. And make sure the terms of the loans, make sure you understand the terms of your loan so you can comply with them and understand what will happen if you don't comply with them. The other thing I need to add is that the power's in your hands and you're responsible because it's your business. Don't let your banker or your broker talk you into something you don't need. Now, like any business, banks and lenders are there to sell and they're there to make money. And a lot of bankers, particularly when I worked in the industry, they're measured on the amount of new loans that they write. So be clear on what you need the loan for, get the advice you need before you sign up to anything, and that's the other benefit of being prepared and seeking finance early, because you'll have the time to look around to see what different lenders offer. All right, so which brings us to key takeaways. So how can you make the whole applying for a business loan easier and less stressful for yourself? Firstly, make yourself more bankable. Stash cash away for a rainy day. Show that you're a good borrower by paying your bills on time and stay on top of your loan repayment so you get a good credit score, and pay your taxes on time, because these are the things your lender's going to check. Manage your cash flow so you know to get finance early. The earlier you are, the more options you're going to have available to you, and the more likely you'll get an approval. The more likely you'll also be able to negotiate a better deal because you had time to shop around. Be on top of your numbers. The more you demonstrate you're across your business, the more confident your lender will have in your loan and your ability to manage that loan. Choose the right loan for your business. It's as we went through before, different your need to borrow might dictate the type of loan you get. So just double check what options are available to you and choose the one thing that suits you best. And then know what you're signing up for. Get the advice you need. Make sure you're not overextending your business. Understand what assets you've pledged, and do what you need to know what you need to do to comply with the terms of your loan. Now, the one thing I do want to point out is needing a loan is not a bad thing. Sometimes the cost of getting an investor or the cost of shareholder capital is actually more expensive than the cost of interest, which actually makes getting a loan a cheaper way of funding your business. It's a concept that we used to call having a lazy balance sheet, where some debt's okay, just make sure it's the right debt for your loan, for your business. The other thing is, again, loans are not a bad thing, and you're not alone in needing to borrow money. Back in 2018, which was the latest data that I could get my hands on, 1 in 3 small businesses needed a loan to ensure the survival of their business, and 1 in 4 needed finance to replace equipment. A report into SME lending in Australia last year found that small businesses were likely to wait until the last minute to apply for their loan. So if you want your loan application to be successful, the real key is planning your cash and knowing your numbers well. Not only will you get more respect for your lender for being on top of your numbers, you'll know how much you'll need to borrow and for how long. And I know I've said it over and over and over, seek finance early. If you wait until you're hanging by a thread, the more likely you're going to grab the first thing that comes along. And that might mean that you end up taking a loan with really onerous conditions and really high interest rates. So the more organised you are, the higher your chances of getting approval, because you're more likely to get a loan if your business is performing well. Now, next steps. So what can you do to make yourself more bankable? So if these are the only 3 things you do, it'll work in your favor. So the 3 simple steps I would suggest that you go for is that make sure you pay your bills and your loan repayments on time, just so you don't get any adverse listings on your credit report. Check whether your taxes are up to date, and make sure that you're all paid up and there's nothing overdue. set up separate bank accounts so you can start putting away money for a rainy day, just so when things go wrong, you've got a bit of a head start. So even a tiny amount each month is a good step to get there. Okay, so those are a couple of things that you can do, and it will certainly help. Now, I do have a tip sheet that covers some of what we have talked about today. Not the ones that you see on the screen. There is a separate one for getting yourself loan ready. My details are on the screen, but there is a follow-up email that will come out after this webinar. So the link will be there. So if you find afterwards you sort of wanted to recap, go through what we talked about today, that tip sheet's there for you to download. Now, just some final thoughts that I wanted to leave you with. Now, we've talked a lot about cash flow and staying on top of your numbers. So not everyone is a numbers person, but the one thing I will say is that managing your cash is critical for business survival. Most businesses, the ASIC statistics show that the main reason small businesses will fold is because of poor cash management. So it's about taking the power into your hands and staying on top of it so you can have a viable, long-standing business. Take action early. The earlier you tackle something, no matter how hard it is, the more likely something's going to work out in your favor. So, and then get the advice you need. No one's an expert in everything. So if it's something related to numbers that you don't understand, ask the right person and have them explain it in a language you understand. Okay, so, and that's it when it comes to for getting your small business loan ready. Now, we've got a couple of more sort of numbers webinars that I'm running through Realize. So next month, as I mentioned, we're going to run through making cash forecasting easy. And again, simple spreadsheet, doesn't have to be a complicated financial model. So we'll run through that next month. April's webinar will be on credit scoring, and we talked about this earlier. So we'll run through a little bit more how credit scoring works, why it matters, and how you can improve your score. And May will be a quick and easy guide to creating a budget, which is quite timely as you start planning for the next financial year. So it's a thank you for me for staying on. We're going to throw to some questions. So, but we have gone through lots of information today. So if you have any questions that you think of later on, drop me a note because I'd love to hear from you. So I think it's over to you, Jacqueline.
Thank you, Amy. And what an excellent, such an informative webinar, and I really love sitting in on your webinars because I feel like we learn so much. So once again, you did not disappoint. Thank you for sharing that with our members in our audience today. So yeah, as Amy said, we are going to throw to you some questions. So I'm going to ask everyone to type in their questions into the chat box now. And take the opportunity to cash in on Amy's expertise while we've got her here live. So just the chat box you can find on the bottom right hand side of your screen. So I've got a question for you now, Amy, while we're waiting for our audience to type in some questions, and that is, is this the kind of thing that can be handed over to a broker to sort out for you?
Yeah, you can. Well, really, it's your business, so you can do whatever you want. So, so yes, you can hand it over to a broker. I guess you need to be on top of your numbers yourself, which is the one thing I'm trying to reiterate. And the other thing is, so you need to know at what point you need a loan, and you need a sense of how much you're going to need and how long. So the only way you're going to know that yourself is you're on top of your numbers. And the other thing I will also say is that, like any industries, there are some very good brokers out there who will work in the best interests of your business. But there's also others that, are more sort of driven on commission. Okay, so a lot of what I mean, it more so pre-GFC. What I saw a lot of was a lot of, from a risk perspective, and it's more highly regulated now, was that there were a lot of loans pushed onto clients by brokers because of the commissions they got paid. So basically they were driven by reward. And it doesn't happen as much these days, but um, some of these loans were quite unconscionable, and they really did put clients' businesses at real risk because they were just way over geared and took on way more debt that, you know, it was just way beyond their capacity to take on. So I guess, yes, you can hand everything to a broker, but what it comes down to is empowering yourself. And again, the key is understanding your numbers and finding the help that you need. So from there, you'll get a better sense of whether a loan proposal feels right for you and your business, and or whether something may get you into trouble. So yes, you can hand everything to a lender, but ultimately, it's your business, and you're going to have the best interest. Like, you know, you're the one who's going to care about it the most. So you can delegate something like that, but ultimately you can't delegate responsibility. So I say empower yourself, because once you build the knowledge in terms of numbers, you'll have that the rest of your entrepreneurial life. It might be a hurdle now, and as I said, not all people are numbers people, but it's certainly something that gets easier with practice. So again, like, you can delegate the task, but you can't delegate the responsibility.
Oh, that's a really good answer, Amy. Thank you. And I love that. Empower yourself, at least know what and understand it, whether you handle it or whether you give it to a broker. I think that's a really good advice for
Yeah.
anyone. I've got a question here from Talisha. Did the Banking Royal Commission change the way lenders look at loans?
Um, There were certainly aspects of the Royal Commission that dealt with small business loans. A lot of it did deal with the way rural and agri loans were dealt with. The majority of what I saw from the Royal Commission dealt with retail banking as well as financial planning and insurance. So, but from what I understand, lending processes have certainly tightened. And even while the Royal Commission was taking place, that lending process and what lenders were looking for was evolving as the commission was taking place. So now the best way to think about it, I think, is that processes are basically tightened because the banks and lenders don't want to be seen as lending irresponsibly. And I did see a lot of this again in my pre-GFC days, which shows my age, that not only, I mentioned there was conduct by brokers, but also there was some unconscionable conduct by bankers themselves, because again, they were rewarded on how much, on the amount of loans that they were writing. So things have changed, yes, things have tightened, but again, that's not necessary. If you make your business bankable, the tighter lending conditions shouldn't have too much effect on you. And again, it's about you being on top of your numbers and knowing what your business needs. So things are tightened, but it shouldn't have too much effect on you. It might mean that you have to produce more reports and they've got more boxes to tick. But if you're selecting something that suits your business and that you can comfortably manage, I don't think the lending restrictions will affect you too much.
Excellent. And one last question, I think, just wrapping that up. How long do you need to be in business to get a loan?
Well, the magic number I've seen lately is 2 years, and that's not based on anything I've read or any source that I've gotten it from. It's just a trend around the market and from talking to people. So 2 years is the magic number. In the same way they asked for 3 years worth of financials. It's strange. It's just this magic number that we always got told to work to. So the way to think about it though, is that most businesses will fold generally within the first 12 months. So I guess the reason they want you to have a trading history is that they want to see that, you know, you have ongoing cash flow, you can run a business, and that you can stay afloat. So basically they want to see a trading history, and that, you know, the other thing to think about as well is that if you don't have much of a trading history, they're going to see you as a higher risk lend. And the higher risk you are, the more expensive your loan is going to be. And the way risk works for lenders is that the higher risk the loan is, the more capital they're going to have to put aside for your loan. So it actually costs the lender more money to lend a high risk loan. So there's a bit of a balance there. So if you have no trading history at all, your loan is going to be highly risky, and if you do get a loan at that stage of your business, it's going to be incredibly expensive. So generally what lenders are looking for is a trading history of some sort, to reassure them that, you've got you can run a business, you can pay your bills. So again, behavioural aspects, and also that, there is some chance of them recouping the loan if you default on it. Now, it seems really brutal, but that's what it boiled down to. Certainly when I was working in risk, it's like, can we get this money back? And that's, I guess it's not a bad way to think, okay, so if that's what the lender is looking for, how can I prove that I'm a good proposition to lend to?
Yeah, wonderful. Thank you for that, Amy. And you're always a wealth of information. I really appreciate that. So it looks like that's the end of our questions. So thank you very much for the webinar today, Amy.
Thank you for having me, Jacqueline.
Thank you, and I hope that everyone takes a look on our website, www.realize.business, and head to our events page, and you can catch up on all of our upcoming events. And we've got a few coming up, just Pub Biz. We've got a mastermind experience night on Tuesday, 25th of February, which I strongly recommend people attend if they're interested in mastermind. You can find out more information on that and all of our events, plus Amy's webinar, are on our events webpage. So it's www.realize.business and head to events. Just one last thing as well. Stay up to date on our social channels if you want to know first up what's coming soon. We've got our Breakfast with an Entrepreneur series, which the next entrepreneur is scheduled for the 31st of March. We haven't announced who it is yet, and this is where you're going to find out first. So go to Realize Business Facebook, LinkedIn, Instagram, follow us, and you'll get everything that we're doing there first and foremost before we notify people through any other promotional channels. So it's worth following us on our page. So once again, thank you so much, Amy. Thank you everyone for joining us. And I look forward to seeing you all online next month for our expert webinar in March, which again is a webinar of Amy's, and it's called Cash Flow Forecasting Can Be Easy, even if you hate numbers and spreadsheets. So to register for that, head over to our website and register for that free webinar today. So we're going to end it here. Again, thank you very much. If you want to engage in any of our other Realize Business services or business advice, head to the Realize Business website for more information. And thanks everyone for joining us.